Hey guys, happy holidays and happy new year. Wanted to hop on here real quick, make a video for you guys, do a little bit of a recap of the Phoenix housing market in 2025. And then I also wanted to give you guys a little bit of a prediction for 2026 moving forward at the end of this video. But just kind of wanted to recap everything that happened in 2025, everything I saw, boots on the ground, open houses, showing activity on listings, kind of just run through some things and give you guys some insight to what happened this year and then some information for next year that I think could be vital for you guys moving forward, whether you're selling, buying, or investing, that you could use for your family and make the best decisions possible for next year. But let's get started. So we'll start here with the Cromford report, the chart that I usually send out every Monday on my market up for you guys to see a good visual. I like this chart because it shows a lot of numbers that are very vital to the housing market, and it shows a good short-term, medium-term, and long-term trend that you guys can kind of follow. It goes up to 2 years, so we can kind of get a gauge when we're looking at inventory and then days on market as well, price per square foot. It's all tracked here, and it's showing positive or negative signs of it if it's trending up or down. So starting here with 2025, you can see we started the year about 22,000 active listings. And then we ended up in December with the last report from last month of today's date. We ended at about 27,000 active homes. Now, if you saw that and you just saw the numbers with no context, you would say, hey, market very slow down. Is this going to keep going up? Are we in a market crash? That's why I just want to kind of explain the numbers and then kind of help roll into my prediction for 2026, what we're kind of seeing here from last year. So in 2025, starting off in January, I would actually say the market was actually pretty booming here. We had a pretty strong buyer demand right out the gate. A lot of my listings that I had listed in that full time period, we had slower activity, but once January came, I noticed during the open houses, we had a lot more feet through the door and we had a lot more showing activity, probably 2 to 3x per week of what we got originally when we first listed in that full time frame. So buyers were out and about. We were seeing a little bit more offer activity as well. It was nothing like 2022 and 2021 where everything was going over asking, but this was at least a good indicator starting off the year that we had some good strength right out the gate. Now, this strength did continue until about June, I would say. Once June came, it really felt like we hit a wall here, I would say, at least from my end, doing real estate the last 6 years here, 7 years, that we really hit a wall that summer. It really slowed up. I noticed some people were busy, some people were not. It was all different price points, different areas, different locations. I know if you're following my market update, I noticed I've been calling out the last couple months that Fountain Hills was a spot that was of interest that a lot of buyers were flocking to, and then some pockets here and there as well. The market overall, though, I felt like it really did hit a wall and it really did slow up. I think it really just got to the buyers this time of year for this year, post COVID, 5 years, 6 years now, that people are just starting to see the unaffordability, even with rates the way they're bouncing between 6 and 7. And rates actually did hit about 7 as we entered the summer, which is the start of why it started to hit a wall. It just seems that a lot of buyers are just deciding to sit on the sideline because one, they're not seeing a lot of inventory, that they're seeing good homes, good aesthetics, good location, good size, good amenities for what their dollar could get them in this market. And then on top of it, having the higher interest rate, we were just in an environment a couple of years ago where it was 3-4%. Payments are completely different now. Buyers today are not getting any relief from the payment side, and they're not getting it from the price side on the interest or the home purchase, the purchase price, I should say. So that's really what's really stalling everything. Because if you actually look here, this Cromford Market Index, the CMI, you could see this has been falling. Now, this is a mix of showing the strength of inventory compared to buyer demand. Now, this number is a little bit inflated just the last couple of weeks. When we ended this year, the back half was really slow, and I was seeing listings sit for a long time. I was seeing a lot of price reductions, And then it seemed like that last month in December, I was seeing a lot more buyers back again at open houses. Nothing crazy offer wise, but a lot more interest. The people were seeing what was out there on the market. What could their dollar get them this time, possibly shopping for January, starting off the new year. So that was a good sign that I was optimistic that the market would pick up a little bit in this month. I know we're only 5 days in, so we got to see. But between the combination of it slowing down in the summertime, so inventory started to build up a little bit, I think buyers were starting to see that. And then a reflection of that, the price was coming down because inventory was starting to expand a little bit with a little bit of that short-term demand falling. So if you're a seller, you probably know and you probably experienced it. It might have felt like a ghost town from some of your listings that, you didn't feel like anybody was coming through, even at open houses. Now, December started to pick that up a little bit, but with that being said, nothing crazy. It wasn't like 2021, 2022. So I say that lightly when I said it picked up, but you're starting to see at least offers being made and not buyers just coming through or no buyers at all and just kind of being looky-loos at that time of year. You are starting to see, but at least from my experience with some of my clients, I am getting buyers to make some offers, but it's nowhere near the price sellers are looking for. So sellers, I noticed, if they've been sitting a while, if they haven't been getting a lot of buyer activity or showing activity, I noticed negotiations have been a little bit weak the back half of the year, as opposed to the front year. The first half of the year, it was a lot stronger. I even saw on some properties I had multiple offers on one of my listings. We actually had 3 offers. One buyer canceled, and then we had 2 multiple offer situations. So I was seeing a lot more interest, and it was a lot closer to list price and offer pricing. But that second half of the year, I had a lot of buyers that we were able to take advantage, that we were able to get concessions and we were able to get a huge discount on the property. And mostly, I believe, is because there is a lot of this doom and gloom sort of mentality that's out there, especially if you see it on YouTube and news articles. A lot of people are pushing that agenda that we're in a market crash. I don't believe we're in a market crash. Now, you can say we're in a little bit of a correction, but I also say we're in a little bit of a stabilization point as well. And if you follow me along, when COVID happened here, everything was going, in 2020, 2021, 2022, everything was going 10, 15, 20% over asking. Like it was crazy. I was seeing 50K cash, waived appraisals, no inspections, 7-day close. They were doing crazy stuff that is not even asked today in this market. But seeing all that craziness, it's sort of like the stock market when something explodes, a stock goes up 50, 60, 70%, you're going to have that pullback. Now, I do believe we are in that pullback phase because real estate is like a cruise ship as opposed to stocks that is like a speedboat. It takes a long time for a real estate market to move back in a different direction. It's got to be a slow turn. It's not overnight that it crashes, unless God forbid something like in '08 where there was a huge crisis within the housing market with these default loans, with these faulty loans. But this time around, I believe, just especially in this Phoenix market, that we had a huge influx of people coming here where they were coming from out of state and they had cash. So they had a little bit of an equity arbitrage, I call it, that they were coming here and able to buy these homes cash or, 50K, 60K over asking price, where they didn't really have to worry about paying that extra because they didn't really care too much because they had such great equity in these other big cities that had bigger property values. LA, Chicago, Seattle, New York, all these other cities. So coming here, that really pushed that pricing up. And now what we've been seeing, and I've mentioned this a couple times in my other video, we really peaked here in June 2022. That was absolute highest pricing in terms of buyer demand with inventory at its lowest. So supply and demand 101, that was the best favor for sellers. Now, of course, some pricing here or there the last couple of years has still gone up in certain locations. I'm not talking about pricing overall. I'm talking about market sentiment. So that was where we truly peaked because mortgage rates, they just started to raise the Fed funds rate, which was about, I think they raised it, 2 times within that summer or within a couple of those months, between a couple of those months. and the mortgage rate went up to about 4 to about 5, I think, percent in that one summer. So that really halted demand. A lot of people didn't know what was going on, and that really froze a lot of stuff. Where now that sentiment's been falling, and that's where we're starting to see, people are reducing their list price dramatically because they're thinking their price was still good because of the 2022 market when they bought. They're now realizing, wow, this is a different market where we're not even getting showings, let alone, multiple offers, 50K over list price. It's really come down a lot. So I think a lot of sellers that are not educated properly by the real estate agent or financial advisor or whoever they're talking to when they're doing all this stuff, not realizing that we're facing that lack of demand, so that pricing's pulling back because that pricing went so high that it's pulling back now, and now we're in that stabilization zone that some sellers are feeling like that's a crash, but it's not a crash. It's the market stabilizing to what they're feeling that the pricing should be, or buyers are feeling what the prices should be for that house, is at least in this market with this rate, even though they would love it to go down more, but they're still feeling like it's a little bit too frothy. So that's where you're getting a lot of these buyers where they're offering, and I've had buyers make offers as well, 10 to 20% off list price. I know that sounds crazy, but I've had sellers meet in the middle or come close to meeting on the other side of where we're looking to get that house, especially with concessions as well. You got to know the area, got to know the location, you got to know what the price per square foot's going for. I know that's vital as well. So you got to know that game right now of what's going on. So that's why for a lot of sellers, it's not panic mode, it's not crash mode. That's not happening, and I'll show you stats on why it's not crash mode. But you do have to price right out the gate. If you're not pricing right out the gate, you're going to lose a lot of buyers' interest, or they're just going to be like, oh, that's way too high, and you're not going to get any showing activity, and you're going to sit stale, and then you possibly could panic and reduce too much of your price and still not get buyers just because you're not realizing it's a slower market, that really just days on market's just expanding instead of it compressing. And then price points are not really reducing at that rate. They just, I mean, at least they don't need to. They're just sitting longer because the showings are taking longer to come up. Buyers are taking their time now. They're not rushing out to go buy, especially in a higher price to market. And like I said, there's a lot of negative sentiment about what's going on with the economy overall, not just the housing market. So it slows people up, especially in that back half. That's why it was a double combo of rates going up to 7% in the summer and then teetering off, and then also in the back half, this is also our slow months, the second half of the season here, the second half of the year, that things start to trickle down regardless because we have the holidays, school starting back up, so those all play a factor. So with that combination, I do think the market is going to be stabilizing a little bit. So rolling into my prediction now for 2026, I'm not trying not make this video too long. I always end up doing this. I talk for 30 minutes, and I apologize to you guys. Try to make this quick for you guys, but just a little prediction. I'll spend about 2 to 5 minutes on this. But for 2026, I do think this is going to be a year of stabilization. I do think it's going to be more of the same from the last 6 months, unless we see a really big pop in demand like we did last year. But that will be just short lived. So if you're a seller, this is the time you do want to list these first 6 months. That's our buying season here in Phoenix. It's January to June. So you want to list now to try to capitalize that, because once again, that second half is naturally always slow here in Phoenix anyways. Even every market condition doesn't matter. It always naturally just kind of slows down with the holidays and school. So you want to capitalize that if you're a seller, but you also want to price right out the gate. So I saw a couple listings the last couple months actually list way lower that I actually thought, wow, that's a good deal. And whether that was the seller's idea or the listing agent's idea, a couple of those homes did get multiple offers. So there are buyers out there, and there are buyers that are being educated right now just from hard truth of seeing the market of what they can get. They are out there scanning. I got buyers on my MLS search. I got Zillow. a bunch of buyers looking at Zillow. They're constantly looking at the estimates and whatnot, seeing offers on there, what value I should say on there. So they're taking their time as well to process everything. And with that being said, they're seeing if there is a good deal or not. So they are just seeing, just from what's going on and what we're passing on, what is a good deal and whatnot. Because they go back to that listing a couple months later and they see the house never sold or it got canceled, or they reduce it. A $1.4 million house got reduced to 1.2, 1.1, and that's a 10-20% dip. So I think as a seller, you got to be realistic in this market. You should be checking weekly as well where demand's at. That's why I always like to post in my updates where demand's kind of fluctuating, because we do get some stints here and there where demand pops because mortgage rates, they drop 0.5%, in a 4-week, 6-week time frame, or there's economic factors of what's going on policy wise that could be affecting housing that you should take advantage as a seller. You should know this as well. A listing isn't just a set it and forget it sort of scenario. It's an organism. You got to look weekly. You got to look monthly, because there's sometimes I saw listings last year, and I've had listings myself experience. Well, they'll sit for a month, but for some reason, either inventory just dropped off for that month because there's a flux of canceled listings, or the inventory just happened to drop naturally because of the season, or a lot of listings came off because of closings, because of mortgage rates. Well, a lot more interest flocked to those other listings now. So now we have to pay attention to that if you're a seller. So that's why those numbers are very important. So in 2026, I think you're going to have more of the same of where the market's going, to be more flat. It's not a rising market. Even rates drop, I would say 0.5%. If we got into the fives, but I don't think we're going to get into the fives. I think we're going to possibly still bounce between 6 and 7, to be honest with you. I know a lot of buyers don't want to hear that, but if we keep bouncing, we just got to watch, where that demand's going to be, because the demand's not coming back as crazy as we thought. Last couple of months, it's been the lower 6s, and it's nothing booming right now. So as a seller, price right. I don't think we're going to have appreciation, if any. We're going to be in a flatland period, I think, for the next year or two, until something, eventually, I would hate to say it, either breaks, either rates drop or the pricing drops to get that demand back, and buyers eventually just officially tap out. So for sellers going into 2026, definitely price right. You don't want to be overpriced. A year or two ago, I was advising some clients, hey, you could put in a cushion of 1 to 2% on the list price, because for negotiation purposes, because buyers at that time were offering 1 to 5% off lists. But right now, you want to be priced out the gate because you really want to get as much activity as possible, because that first offer might not be great. And I hate to say it, but you might not get another offer for a while, or a second one close, because if you got to keep doing price reductions to get that activity back, it's not going to be looking good. It's not going to be looking good on your listings at all. So really price well right out the gate. I know I sound like a broken record, but I know a lot of sellers, they're still thinking it's possibly that old market, but you got to price right and make sure you're getting that activity right out the gate, because if not, then you don't want to be sitting. I mean, in this market, you don't want to be sitting 100 plus days. That's the market average right now. As you can see right here, we're about 108, 4 months supply. 6 months is technically a balance, but here in Phoenix, 4 months is basically, I would say, a balanced market here, just because of the influx of people we get from out of state and stuff, transporting here. And so price right out the gate. Don't laugh at the first low bowl offer you get. Not saying you got to accept it, but take it somewhat serious. I mean, try to negotiate. You still have negotiation power because of your equity, but buyers, they'll walk. I've had a couple buyers walk. They don't really care about the pricing if it's not what they're looking for, or they're not at least getting concessions. And that's another thing as well. As sellers, you should be offering some sort of concessions to hopefully buy down that rate and then help strengthen the buyer's offer for you guys if you guys are looking to net more on that backside. Now, for buyers in 2026, I do think there's going to be a lot of opportunity. I don't think there's going to be a lot of opportunity for people that are looking to buy to fix up because it's not that market right now. So if you're trying to buy something, hey, because of the purchase price, this fits my mortgage better, my payment better. With the rates, I'd rather go cheaper and then just spend money over time, um, and fix it up and try to build the equity. I don't think that's the market for it. Me personally, I do think pricing might come down, not in the next year, but the next maybe couple of years, maybe 5 to 10%. Nothing crazy, nothing crash level, but I do think it's going to be a slow drip down of pricing. And as a buyer, I think this is actually more of an opportunity for you to go find that move-in ready house and get a huge discount right off the bat. Save the money on the labor, save the money on the material. Don't invest that money, especially where the economy is not doing too well. Overall, you never know what happens, especially God forbid with your job. You never know if your wife lost your job or you lost your job or something. You don't want to be in a tight bind where you really can't escape on the back end if you fix it up and try to flip it or sell it to make that money. You might actually need to spend that money at that point just to fix it up, just to possibly break even, if that makes any sense. You might actually be going backwards and might have to do extra work just to break even. So I don't think those properties is ideal for a first-time home buyer, somebody that's looking for solid equity. I think you're better right now in 2026 by getting your equity just negotiating off the purchase price. Get something that's solid, that's move-in ready, newer. Don't waste that time doing it unless, of course, you could buy a house at the right price that makes complete sense, that long term, even if the pricing comes down a little bit, you are protected with that, that you got it at such a cheap point. Because there are sellers, even at that point, at that price point, at the wholesale level, where they're scared as well. They want it off the property because they're getting mixed signals that, hey, the market's crashing, not really understanding the market dynamics right now of supply and demand. Both have just completely dropped. That's why the market feels the last year and or I should say last 6 months, it felt like it was dead. There was no buyers and the listings were just sitting. So everything's just, nothing was moving. And then open houses, it was kind of dead as well. So that's my prediction for 2026 for sellers and buyers. And I'll show you just quick little stats why we're not in a market crash, and just some economic numbers right here, so you can kind of see where economically we are as a country and what's happening. And should we prepare, and then if it's the best decision for you to sell or buy. But why we're not in a crash, I'll show you these extremes right now, so you can see these numbers. I've had them on the screen the last couple of minutes, so you get a good gauge of these. This goes out every Monday on my market update. But you can see the month supply has been increasing. Inventory's been increasing. Increased from this point 2 years ago, this date 2 years ago, about 7,000 homes. Now, a lot of people will see that and be like, wow, this is a market crash. That's why me as a professional, I'm here to tell you the numbers and interpret them for you. 17,000 is actually on the lower side for inventory here in Phoenix. So that actually is that's a stronger number towards the sellers, believe it or not. When the market peaked here in 2022, we actually had about 4,000 homes on market. So that gives you some context as to we're closer to the seller side at that number, and even going up to that 24,000 where we're at today on inventory, active listings, where it's more still in a balanced seller market if priced correctly. So that's why we need to keep an eye on that number if it keeps growing or if it comes down the next couple of months, especially right now as we're entering the buying season. If this number is going to go down a little bit and if buyer demand comes back a little bit, or if this is going to go up and buyer demand is going back down, then that could be a problem for pricing coming down a little bit further. But then again, we have the variable of interest rates, which we have to watch as well. So as you can see, these numbers right here, it is increasing. 24,000 is more, like I said, back in a balanced market. I would say about 22 to about 28,000, maybe even 30,000 is still a balanced market, because it could hit either way. Because this is all of Phoenix Metro, including Scottsdale, these numbers. So that could be, certain pockets just getting a little more inventory than others. So you've really got to watch. It's data dependent of, each local city of whatever city you're in. You got to watch your inventory because some cities still have no inventory, or some cities are exploding with inventory more on the outskirts right now. Buckeye, Avondale's getting a lot more inventory. And I just know personally, a lot of hedge funds were out there buying back in 2021, 2022, why a lot of inventory is now coming back on market because they're trying to sell off now. But I'll show you the extremes, and this is why we're not in a market crash here. So these are market crash numbers from 07, 08. As you can see, the active listings, we got as high as 58,000. 58,000 homes. That's crazy. That's almost double inventory, double and some change from where we're at right now. So it's just a crazy number to think about. A lot of people are saying, hey, we're in a market crash. Meanwhile, we're not even at the halfway point of what the market crash numbers were back in 07. So it just doesn't really make sense of what people are saying. And it's just kind of tight with, people saying a market crash. I still think it's a stabilization point. Do we go further down or further up from here? Yes, I agree with that. I do think the next year or two, depending on what happens economically or policy wise with the government, whatever happens, that could start to fluctuate. Or even, I hate to say God forbid, but AI with unemployment rising, that could be a sort of a black swan thing that we're not really seeing. That's what happened in 07 with the ninja loans, no income, no job, no asset loans that exploded everything because everything reset with the mortgage rates. If you live through it, you understand completely. The whole market crash was based on housing, where this time housing's not really causing the crash, but we are getting affected by what's going on economically. So you can see average here, typical, is about 26,000, and we're underneath that. So that's more of a balanced market. That's where the market naturally likes to have that number. Now, that's a number that's, it's going to benefit sellers and buyers if you're priced right, if you got a good aesthetic house, good price point, good neighborhood. That's where, it's a balanced market overall. And, you're going to still have buyers ask for repairs, but they could pay close to list price, or you might have buyers want discount, but they're okay with no repairs. It's give and take at that point, more of that balance, neutrality in that market. We just got to watch demand at that point. And then, you can see some of these other numbers here. I mean, look at months of supply in 08. This is insane. This is, 4 or 5x what we're at right now. So that's why I say, if you see somebody talking about market crash, are we in a correction? Yes. Are we pulling back? Yes. The data shows that. It's showing the pricing coming down. And once again, it's just because I think, personally, my opinion, the market went so crazy, it's now finding a stabilization point where people are like, okay, that's justifying the price at that price point for that house or this square footage or this neighborhood. And it's not so ridiculous now for some of these homes. And then some buyers are, they are going out there and they are making lower offers than the list price, and they are getting them accepted. I had it done with the client, like I said, and we got full concessions. We had it done. And guess what? It appraised higher. And the thing was, the house was just sitting. It was 100 days on market. So there are buyers that are winning out there if you're taking advantage. Now, if you find the right house and there's some activity, yeah, you might want to make a strong offer. But, if you're okay waiting, or you're okay renting, or you're okay in your living situation where you're at right now, and you're looking for a deal, then go make some offers. There's no problem with that. No problem at all. I mean, you'll find a seller. Some sellers aren't desperate because they need the equity, but some are. Some do need to get out. Some, do have some unfortunate situations, or they're cash tight, and or they actually have money and they don't really care too much about the equity. They just want to offload the property. So that could happen as well. So showing those numbers, we're not in a crash. So if you're seeing, YouTubers or people in articles on CNBC saying market crash or foreclosures are up 50%, yeah, all those numbers are true. They are true. A lot of the data, if you go look, you can check it out. It is true. But a lot of the times, they're not telling you the full story that we're at all-time lows or we're coming off all-time lows. So yeah, when you hear a big number, inventory's up 20%, like I just said, which is true, we are up 20%. But 20% seems like a big number in the head that you're like, oh my God, market's crashing. Meanwhile, we're not even close to 50% of the market crash numbers. So that's why, articles and headlines can be very deceptive. You really got to do your own research. And that's why I really advise people, buyers and sellers and investors, look at the numbers, see what's tracking, see what the true price per square foot is, see what the month's supply is. And yeah, of course, nobody's got a crystal ball where the market's going to go, but at least you got gauge and you got historical proof showing that we're not in a crash or we're not in an uptrend. If it went the other way, and you can see by inventory, hey, pricing's shooting back up just because there was one good month in this year or last year that people start saying, oh, the market's back, we're going back up 10, 20%. Or you start seeing Redfin and Zillow say all these BS stats where, of course, they're a real estate company. They're going to try and juice it up. They don't want negative headlines. They never dealt with a negative headline because they started after '08. So they never dealt with a bearish cycle. And, they need to make money off the agents, off the leads and the advertising and all that. So that's why I just take it with a grain of salt. Do your own research. If you ever have questions or comments or concerns, you can always reach out to me. Listen, I'll shoot you straight, and tell me your situation. We can guide you properly and build a game plan onto what you're trying to accomplish, and then long term of your goals of what you're looking to do, and then we can kind of find the right property, right fit, or right timing to get you in. So that's just something to look at. So these are the numbers for the extremes highs and lows. So hopefully you guys you can take a screenshot of this if you guys need this, or if you guys need this, you can email, text me, and I can send it right to you as well. But then just to finish off here, I'll show you these last two little stats. So I just wanted to show you that the Fed's fund rate is coming down. It has been cutting down. If you haven't been watching the news the last couple of months, or you're not really into the financial markets, the Fed funds rate is dropping. Now, this rate is not directly tied to mortgage rates. So I know a lot of people sometimes get that confused. This does, however, affect credit card rates, auto loans directly, and this actually affects the money that's being used by new home builders. So that does play a little effect into the housing, but not directly into resales or buyers buying for resale purposes in terms of getting a mortgage. So you got to watch this number overall if this keeps going down, because what that also means too is that when the number goes up, when this Fed's fund, as you can see, look, when I said it was peaking in 2022, look, Fed's fund was going up and it shot up, 2 points, 3 points in a 4 or 5 month time span. That's a lot. That went up very quickly. So there's a great book if you ever want to read it. It's called The Creature from Jekyll Island. It's about the Federal Reserve, and it's a great book, and it really talks about market cycles, and it talks about when the Fed's fund rate goes up, like it does here, it means the economy is going to have a contraction because money is tight. So you're not going to be making money from savings. Borrowing money is more expensive. So naturally, the flow of money stays tighter. But as you can see, as it starts to unravel and it starts to expand back, money will expand back. And then people will start borrowing again because everything is cheap. And that's exactly what happened here. This is why mortgage rates drop so low. Mortgage rates is more tied to the 10-year treasury yield. That's what in terms caused this. It was a domino effect. That dropped so low, the Fed's funds rate. It just made sense, the arbitrage of the lower rate, to do that. But as you can see, as it jacked back up, that's when the market really peaked and really stopped with the market sentiment of housing, because it dropped because mortgage rates, we haven't been below 5 since that period, since 2022, 2023. So, and then you can see the rates are dropping a little bit. So we are getting a little bit mixed results here. And we got to see if that keeps continuing or if it stays flat for this year. So Jerome Powell, the Fed chair, we just got to see if that's going to keep going on and if they're going to keep cutting rates. I know he's getting replaced in May, possibly. Trump's replacing him, or they're electing somebody. I don't know the exact process they're doing now anymore, because I think he said he might come back or something. I heard news the other day, but who knows what's going on. But we just got to watch with this, make sure this kind of stays flatline. I mean, if it does stay flatline, that it could have some economic impacts. And I mean, the money's not going to keep getting cheaper for all goods, services, and everything that's being borrowed, loan-wise, mortgage-wise, all this sort of stuff. It's all connected in that sense. And then these are just, let's see, these last two. This is the last two. I just wanted to show this as well. So sellers, if you have a little time to look at this, just a little perspective to see, credit card debt is going up. And it's going up very drastically. It's going pretty wild, and you'll see. Put on Let's see if we do 10 years. We'll do max. You see credit card debt is just, it's ballooning. People just can't afford goods and services right now. And that's not a good sign, especially when inflation is dropping down and we're close to our target number of 2. That's not a good sign. So you can see these combinations when you start adding these numbers. Credit card debt's going up. Fed's funds still high. It's coming down a little bit. It's still high, so borrowing is still a little bit costly. Mortgage rates are a little bit high, higher than what we've experienced the last couple of years. So that combination of everything, and if the Fed funds stays the same, people are it's gonna get tight. It's gonna get tight for people. I hate to say it, and especially if this might still keep going up too. If unemployment, we got to watch unemployment numbers because it's been slowly creeping up, and that's usually the last factor, the last stat to show before a market crashes. It's a lagging indicator. So by the time it's already reached 10%, 8%, the market's already been crashed. We just got to watch that number, and I'm curious to see how AI is going to play into this with job loss. Amazon said something about laying off 600,000 people the next couple of years. I know they already started a few of that, and they're one of the big employers in the country. Same with Walmart. So we got to see if those numbers keep going. If they're going to keep having job layoffs and they're going to keep saying AI, 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 if we're going to have this influx of AI resources being used and then job losses. Because I will tell you what, people will sell their house then at that point and start getting into even more of a panic mode and sell off their properties because they have such equity, since property values here have gone up 40, 50, 60% in some areas. So they'll be the first to sell that and hop into a rental before they let their house get foreclosed on because they're not making the payments. Meanwhile, they're sitting on $200,000, $300,000, $400,000 of equity. So we just got to think of that as well. Do I think it will cause a crash level like '08? No, but it could cause some serious price reflection and coming down, and reductions, I should say, coming down if that were to happen. But that could be gradual. That might not be a sudden thing. I don't think they're going to lay off 2 million people overnight. So it's just something we got to give or take. It just could be fuel for the housing market, I would say, for price reductions or a price correction if we keep seeing more and more and more unemployment. So it's something we just definitely got to keep an eye on and watch this. I mean, these are some of the things I watch. I don't have the stat up now, but another stat I watch is auto loan repos, which has been going up. So credit card payments, car repos, Fed funds rate, and then I watch the 10-year Treasury as well. Those are kind of my 4 indicators that I kind of, and unemployment. Those are my 5 indicators that I kind of watch and just have a loose gauge on, just to see what's the average buyer looking like. What's their pain reflection of their debt, of what's going on and what's kind of going on with the economy. So you can see when borrowing gets more expensive, it gets harder. People have to use their credit cards for groceries or basic necessities, to get a haircut, little things. Just because money's tight and they might not be saving as much, and incomes haven't really grown to afford that new housing payment or the new car payment, because car pricing's gone crazy too. So watch that stat. And then this is the last one I just want to show too. I'm sure everybody's heard of this, the national debt of what's been going on since 2020. I mean, you could see right here. I mean, look at this. Look how much money we've printed. What is that, 23? That's about $13 trillion we're in total debt for the country. Yeah, that's not a good sign. That's not a good sign. But I don't know where this is going to lead us. Does this cause a housing crash? I mean, if this caused a housing crash, it'd probably cause a national crisis. I'd be honest. It's something, if the U.S. defaulted on this, or if we lost, our U.S. dollar reserve currency, if we stop being the reserve currency. But I do think recent actions in Venezuela that just happened recently, I believe a lot of that has to do with the national debt and with oil and with keeping inflation down and sort of keeping the party running. So I do think that's going to be a huge factor. So I think that did buy us a lot of time if we do end up taking a lot of those resources. Now, of course, that's a whole nother economic discussion we can have, or debate about if that's a good thing or a bad thing. But I think economically, not saying it's a right thing, but economically, if we do get some of those materials and resources, it's only going to help drop the pricing here, which could, like I said, further this party even further. So we could be seeing more of that. So just wanted to show you guys his stats. Just wanted to kind of relay what I saw in 2025, what I kind of predict in 2026. I do this every time. I apologize, guys. I try to do a 5-minute video, it turns to 42 minutes, 43 minutes. I appreciate you if you stayed this long. If you have any comments, questions, concerns, any ideas, any at all, please feel free to reach out, email me, text me. I'm here for you guys. You know, I only want the best information for you guys. Like I said, everybody's got a different timeline if they're selling or buying or investing. Housing is the one thing that we all need, whether it's a rental or buying or selling or investing, or if you want to get into that avenue, it's a basic necessity we all need. So I would love to help you if you need help, if you got questions, if you got a game plan. With all this information, I know it seems a little gloomy, but you know, housing, once again, if you're buying as a primary, it's going to be your home, not an investment long term. That's some people look at it the wrong way. You got to look at what's going on. You got to look at your situation, what's your current payment structure, what's your income structure, and you know what do you need? It might not be the best time to buy for you, even with this pricing, with the rates, or it could be the best time to buy for you because maybe you wanted to buy 3 years ago and it was super expensive, and now it's kind of a little bit cheaper and you possibly could get a deal. So, you know, check that out. If you guys got any, like I said, comments, concerns, questions, you know, reach out to me. I also am too a licensed contractor. So if you guys have a house that needs some work and whatnot, I have a lot of renovation offers that are in my market update, in my email template as well that goes out. So if you guys click on that, there's a lot of free pro bono work that I do offer doing business wise that could help you guys as well too. That also, if your seller could add to the value of your property to help entice some buyers, or buyers, it could help you walk into equity. I've already done it with 3 buyers this year. They walked in with renovations, half off material cost, half off paint, you know, free demo on the flooring and whatnot. So, you know, if that's an avenue that you think might interest you, I'm also tied to a lender that does an FH 203K loan program, and the convention rehab loan program as well. If you want to talk more about it, you can text or DM me on the side or email me on the side. That you can wrap off some of the construction costs as well. If you want to do a little bit more of a big project, we could wrap that into the purchase price as well. So feel free, reach out. And if you're an investor as well, I got off-market properties and I deal with investors as well, as I'm an investor myself. So, you know, reach out. And, you know, I wish everybody a happy New Year's 2026. I think it's going to be a good year overall if you keep your head out of the sand and you keep your head above, and you constantly are just keeping on identifying what's going on in the market and just checking on, you know, the news. And if you catch up with my market update, I'm always reaching out and trying to get the best little tidbits that I can, and any little information that can help you guys with the housing data. So have a good year. I'm going to try to keep up. I know I promised last year to try to do a little bit more videos on this, a little bit video updates. I'll try, and I promise I'll try and make shorter video, maybe once a month, once a week, however it ends up being, if I got some time. I've been a little bit busy work-wise, so I'll try to keep up to it and get you guys as much information as possible. But other than that, thank you for listening and watching, and wish you guys a great 2026. Hope to see you out there. Bye.